Good afternoon, everyone. My name is Lily Sella, and I'm the marketing manager for Private Vista. Private Vista is a financial planning and wealth management firm with offices located in Chicago and Oak Brook, Illinois. We manage $1.5 billion for a variety of clients, from professionals to business owners. We use our resources to help each client achieve the goal of leading an enriched life, their Private Vista. We are so thrilled to have you join us for our last informational session of 2020. But first, we have a few housekeeping items. As a participant, you will be on mute during the entire presentation. We will be dedicating about 35 minutes of the program to presenting information, and of course, we encourage all comments and questions. You may send those by using the chat box in the lower right portion of your screen. Anything entered will be completely confidential, as it will not be seen by any other attendee. Now, I would like to hand the baton to Mary Beth McLean to introduce our panelists.
Thank you, Lily. Welcome, everybody. My name is Mary Beth McLean, and I'm a partner at Private Vista. It is my honor to introduce our esteemed panelists from Cray Kaiser Limited. Cray Kaiser is a premier accounting firm that specializes in family businesses and closely held organizations. They are not just numbers people, they are people. Natalie McHugh brings over 20 years of experience to her role of tax manager. Working directly with CK's diverse client roster on full-service tax planning, compliance, and consulting, Natalie enjoys nothing more than diffusing the quote-unquote scary moments, most often involving the IRS, when she knows her expertise can help resolve matters and take clients' fear out of the equation. Karen Snodgrass oversees Cray Kaiser's tax division with niche expertise in closely held and family-owned businesses. In her tax planning work, she minimizes liability at the entity and individual level by helping clients think through the tax implications of their decisions throughout the year. A CK principal since 2001, Deanna executes assurance, strategic, and tax planning services across the client portfolio. For closely held and family-owned businesses, she focuses on the value she can bring to the family and owners. For nonprofit clients, she manages internal control procedures, budgeting, governance issues, and audit and compliance issues. Deanna also handles special M&A engagements on the buy side and sell side. As Ben Franklin famously pointed out many years ago, the only things certain in life are death and taxes. Without further ado, we will let our panelists discuss on how to help with the latter for at least the remainder of this year and in 2021.
Thanks, Mary Beth. Welcome everybody to your lunchtime. Hopefully you've got a nice array of specialty goods in front of you, because you'll need some energy as we kind of get through these navigations of evolving tax climate subject matter. Before we get into it, I just wanted to share a couple of other points about Cray Kaiser and our approach. We've been doing this for 48 years as a firm. The group of advisors you have with us today have been each here and contributing for quite a bit of time. We're very couture in our approach in terms of making sure that our clients have people with them that are listening to them, as well as participating in their tax planning and decision-making processes. I mean, our jobs as practitioners are to get our clients to their transaction, whatever that transaction is, sale of business, retirement, and thereafter. So we participate in all those activities throughout the lifeline of their business and individual cycle. So Lily, want to start up with the next slide, please? Again, Deanna Salo, Karen Snodgrass, and Natalie McHugh, and I want to get over our goals. We're very goal-oriented, so we want to make sure we touch upon these things. So for those of you listening in, we'll go to the goal slide. Next slide, thank you. So we're going to be covering the CARES Act updates. We've heard a lot about this in the news. Whether you're an individual or business owner, this has been the foundation beyond the COVID news of what's going on from a regulation and tax planning perspective. We'll be covering the PPP loans, the Paycheck Protection Program Act that was part of the CARES Act, and what those loans mean. And if you're not a business owner, that's okay. You need to understand what the implications of this are at an individual level as well. Year-end tax planning strategies for both the individual and business we're going to be covering today. President-elect Biden's tax plan, and then as we noted before, we will definitely have some time for Q&A at the end. So with that, let's get on with the show. And I will I'll let Karen Snodgrass go next. Next slide, please.
Thanks, Deanna. And if we can go to the next slide, we're going to talk first about probably one of the hot topics in terms of the CARES Act. And as we all know, the CARES Act was really a function of the government trying to help individuals as well as mostly businesses throughout this pandemic time. So probably, you know, if you are a retiree or of retirement age, probably one of the things that has been in the headlines for you is the suspension of the required minimum distributions. So as you are well aware, if you are of retirement age, essentially you need to take distributions out of your qualified retirement plan. For 2020, they basically said you're not required to do that. So the impact is a lot of our individual tax clients that maybe don't need these funds have decided that they're going to skip the RMDs for 2020. Now, by skipping the RMDs, it creates some other tax planning opportunities that we're going to talk about a little bit later. But in essence, it's a full-blown skip. It doesn't impact what's going to happen in 2021. For example, we've gotten questions by saying, well, if I skip my 2020 RMD, does that mean I need to take twice as much as in 2021? And the answer is really no. In effect, the 2021 RMD will be computed essentially as it is in every other year, looking at the value as of December 31st, 2020, and determining the annual amount based on the factors laid out in the tables. The other thing that it doesn't impact necessarily is qualified charitable distributions. So just to give you a little bit of background, with required minimum distributions, those that are charitably inclined may select a charity to take some of their required distribution. By doing that, in effect, you don't have the income add back of the distribution, nor do you get the charitable deduction. The benefit of that is that it's lower income. So basically, some of the deductions and exemptions you lose as your income grows. You don't have those limitations by using the charitable distribution. So in essence, you can still choose to direct up to $100,000 of an IRA distribution to a charity in 2020 should you elect to do so. Next slide, please. So the next part of the CARES Act was really focused on allowing individuals to tap into their retirement plan. If you recall in March, and even as we sit here today, there are a lot of businesses that have been shut down, a lot of individuals that can't work, you know, whether it's because the business has been shut down, or maybe there's daycare issues, or they themselves have gotten sick. So for 2020, effectively, we have penalty relief. And what this means is if you have an IRA or a 401k and you're under 59 and a half, any distribution that you take out of the plan before you're 59 and a half is subject to a 10% penalty. For 2020 and 2020 alone, you can actually take a distribution of up to $100,000 and not be subject to the 10% penalty. And the IRS has been very lenient in terms of who qualifies for this penalty relief. Yes, the law reads, have you had COVID? Has someone in your family had COVID? Have you lost your job? Do you not have daycare? But at the end of the day, when you complete your tax return, there's not going to be a line suggesting that you need to prove financial need for this distribution. So it is an option for those that are in dire straits to take that distribution. It's not subject to the 10% early withdrawal penalty, but it's really important to remember that it's still going to be subject to income tax. That doesn't change. There is a little bit of relief in that you can spread that income pickup over 3 years. You can elect to do so. So it might take a little bit of the sting of the income tax ramifications. Again, in the interest of trying to tap into retirement funds, the 401k plan loan provisions, those actually need to be elected by the employers. So effectively, employers are required to elect into these provisions, The repayments basically have, there's a 1 year longer period in terms of making that loan repayment. And again, the eligibility requirements have been expanded so you can take more of a loan in 2020. Next slide, please. Again, in the interest of pushing cash flow out, net operating losses. So specifically thinking about individuals and businesses. Anytime you have a negative taxable income, it could create a situation where you have what's called a net operating loss. And way back when, we were able to carry back net operating losses in order to recoup previously paid taxes, but essentially they revamped those rules so losses could only be carried forward. That's since changed. So for 2018, 2019, and 2020, understanding taxpayers have had difficulties, you do have the ability to carry the loss back. So what that's done is that's created a loss carryback opportunity, which means generating refunds for clients. Also, business loss limitations. In the past, there were losses on how much business loss could offset income. Those have been lifted. Capital loss rules remain unchanged. We're going to talk a little bit about tax brackets and what we see going forward. So it's important to think about those tax brackets as we're thinking about, do we carry the loss back or do we carry the loss forward? Next slide, please. There's also, again, in the interest of helping charities that have really been under a lot of stress in COVID time, there's an enhanced charitable contribution deduction. So those that are charitably inclined know that for 2020, if you make a cash contribution to a qualified charity, this does not include a donor advised fund, 100% of your contribution can offset your taxable income. In prior years, those have been capped based on your adjusted gross income. But for 2020, there's a really strong deduction available for those cash contributions. Additionally, for those clients that don't itemize their deductions, and we're going to talk a little bit about itemized versus standard in a few minutes. For those that don't itemize, you can actually deduct $300 of charitable contributions against your taxable income. So again, that's whether you itemize or not. So again, the goal is to really help charities. Next slide, please. And with that, I'm going to turn it over to Deanna Salo to talk a little bit about the payroll, the Paycheck Protection Plan. Deanna?
Thank you. So while this effort today is to talk about tax planning opportunities, we'd be remiss if we didn't talk about the PPP. The Paycheck Protection Plan came about as part of the CARES Act to afford businesses the opportunity to borrow money. It is a PPP loan, if you will, and that loan was set to be used specifically to pay their employees, to keep them employed, even though amidst shortages of work and things like that were taking place. It was really the Congress's way to get money to business owners so that the business owners could get it directly to the employees on a fast track basis, meaning W-2 wages. Otherwise, businesses would have put everybody on unemployment. Not to say that many didn't, some did, but this avoided that longer lines at the unemployment agencies and longer delays to getting money in people's pockets to survive this effort against COVID. So what ended up happening is these PPP loans are sitting on the financial statements of the business's books. It's debt, it's an obligation until it's forgiven. And just to kind of stay at a high level today with respect to the process of this, many of the businesses could be right now in the process of applying for the loan forgiveness, provided you spend the money in accordance to what it was deemed for, which is payroll, utilities, rent, things of that nature to operate the business. Most companies will be afforded a forgiveness of this. What does that mean? So back in July, the IRS kind of kicked the tires on it and said, oh, you know, IRS, Congress, don't forget we have provisions in the already stated law that says if we get tax-free income, if I get tax-free money, any money that I use to pay expenses with that tax-free money, those expenses are not deductible. So the original CARES Act, when they regulated around PPP, it basically said, here's money, should you qualify, use the money in accordance to the way it's supposed to, you will be forgiven, and oh, by the way, it won't be taxable to you. That was the original intention of the CARES Act. But then again, in the summer, the IRS reminded them to say, hey, listen, guys, if you get tax-free money and you use it for expenses, deductible expenses, otherwise known as payroll, utilities, rent, they're not saying that those are non-deductible. So it kind of was in a standoff at that time. Congress didn't respond to it. IRS kind of said, hey, remember the law. Then the events of November 19th, just a week and a half ago or so, the commissioner came out on the eve of November 18th, and it was a hot topic on November 19th, as we're sitting here doing year-end planning with most of our clients, to say the IRS is going to take the position, until otherwise heard from Congress, that regardless of the forgiveness of the loan, regardless of the forgiveness, so it would become taxable income upon the forgiveness of the loan. So our play with clients was like, well, let's just kind of wait and see. Maybe we won't rush to get forgiven in 2020. Perhaps we'll go for forgiveness in 2021 and maybe defer that income into next year. The IRS came out on November 19th and basically said, regardless of when it is officially forgiven by the bank and SBA, it will be taxable income in 2020 to the extent that it is expected. Your expectation is that it would be forgiven. So all of a sudden, all of the tax planning discussions we had through November 18th were basically thrown to the side, and now we have to believe in the position of the IRS until Congress comes back to give a response, which we hope that they will do soon. They have to do it soon because the IRS is trying to get their forms ready for the year end and get the processes involved in terms of getting filings done. So we are right now today awaiting Congress to react to the response of the IRS to say, listen, it is going to be a taxable transaction in 2020, regardless of forgiveness taking place or not. So how does this affect you as an owner and investor? Well, it does. If I'm just an investor and I'm not active in the business for which I receive a K-1, or I'm retired and my children are running the business, but I still have a minority ownership position in it, that PPP loan, based upon the IRS's response to date, will be considered to be taxable. Some of our clients got $100,000, some of our clients got a few $1 million. All of a sudden, if you're taking those dollars and dropping them right to the bottom line, will clearly create a taxable situation for which people are not been prepared for. And to come up with this information on November 19th, very late in the year, after our third quarter estimated tax payments, with only 1 quarter left to get estimated tax payments to be paid in January, is a very short period of time to be able to react. Next slide, please.
Hey, Dee, before we go to the next slide, I don't mean to interject here, but we are hearing that some people are having some issues with the audio portion, and we're thinking there might be a computer issue. So we are going to suggest that everybody call using their cell phones, and the number is 914-614-3221, and the ID is 950-011-831. And then you just press pound because there will not be a PIN. And I'm going to repeat this. So the phone number is 914-614-3221. Meeting ID is 950-011-831. Thank you.
Really quickly as well, this is Lily. I have had a few questions come in along the lines of a recording, and yes, we will absolutely be sending a recording to those who request, and then all the registrants as well. Thank you so much.
Thank you, Lily. Thanks, Dee. Sorry for the interruption.
No worries. If they can't hear us, it's they can only read our information. So no, for sure, we want everybody to be able to hear us.
Thank you.
Next slide, Lily. So the taxability of forgiveness, again, I mentioned the CARES Act intention was that here's the money, you use it correctly, If you use it correctly, you apply for the loan, you follow the yellow brick road of the rules, you'll be forgiven, and that money, once forgiven, will not be taxable. The IRS's response, as I mentioned before, is such to say, sorry, until we get some regulations that clarify the CARES Act intention, because the pre-existing regulations said if I get tax-free income and use it for expenses, those expenses are not deductible. Examples of this are as follows. Right now, we're doing a lot of tax planning with our business and individual clients and really doing pro formas of what their tax returns are going to be looking like with the PPP funds in play in their taxable income and without them being in play. You know, our approach when we prepare individual tax returns is we're looking at safe harbor limitations, paying in 110% of the prior year tax. Some people having softer years and projecting a softer year in 2020 because of COVID, they said, I'm not going to do the safe harbor. I don't want to give the IRS 110% of my 2019 tax. That's way too much money. So a lot of people changed and shifted after, you know, April 15th, July 15th, our new due date this past year, and amended their estimated taxes to basically just cover 100% of the 2020 tax, assuming it was going to be a really soft year. Well, now, all of a sudden, if we're now adding this $100,000, $200,000, $2 million of PPP money to their bottom line taxable income, many people are going to be in a penalty situation. What we do not know today is because of them coming out so late in this year, if there will be any type of penalty relief with respect to underpayment of taxes. But right now, we're advising our clients to let's take another look at this with and without PPP, and maybe we should get ourselves trued up. Yes, in a very short order of time, but getting ourselves in touch with 110% of the prior year tax for federal safe harbor provisions. So again, we're taking the approach of we got to look at it. We got to look at it both ways, and so that our clients are prepared for what might be taxable income. Some of the other business discussions look like this. Clients are like, I would have never taken this money back in April, May, if I knew it was going to be taxable, and now I'll have to pay taxes on it. There are some clients that may not apply for forgiveness. They may keep it as a 1% loan over the 2 or 5 year period. So there's lots of discussions in the planning. What does this mean to you as an individual if you're an active owner in your business or maybe a silent owner in an investment interest? You may want to be looking at some tax planning for yourself depending upon what that business is, what type of PPP money they might have received this year, because your taxable income from that entity may be higher than what you initially anticipated. Next slide, please. So the year-end planning for businesses, again, we're doing it with and without. Year-end tax planning for businesses, we're looking at research and development credits. We have a number of manufacturing clients. Those R&D credits are still there, still very valuable to clients, have been for a few years, and so we're looking at that. If any of our clients are looking at or have built anything in this year, construction-wise, obviously cost segregation studies for the businesses, to optimize depreciation deductions to effectively lower their effective tax rate on those CapEx costs that they've had there as well. You know, from an individual planning perspective, and Natalie's going to touch upon some of the charitable giving closer here to year end. Some of those things are in play as well. We've got a number of clients looking at gifting, and again, Natalie's going to cover that in a few minutes in terms of estate planning with the President-elect Biden's plan. So year-end planning for businesses is really taking a look at where they're at today, where they operationally believe that they're going to be come year end, and then obviously layering on top of that the discussion of how the PPP funds are going to potentially affect their business taxable income, which is then most of our clients are considered pass-through entities. They're S-corps or partnerships. The individuals get a K-1 from their filings, and then they'll have to have this potentially increased taxable income for 2020. The timing of filing business returns, you know, we do actually have a number of fiscal clients. We have some June 30th year-end clients and some September 30th year-end clients, and you know, their year-end is done. And now all of a sudden on November 18th, the commissioner came out to suggest that this is taxable income. So without Congress's response, we've actually extended those tax returns intentionally, not because we're lazy and didn't want to get them done. We actually had the information completed, but we're going to extend those tax returns because we're not going to automatically put that PPP money on top of their taxable income and have them file returns when we really, the other half of the conversation's yet to be completed in terms of Congress's responses to this. So as you're planning your individual tax liabilities for 2020, whether you've had a softer year of profitability from your business or wages or whatever, if you are an investor, an owner, shareholder, partner, in a pass-through entity, the PPP monies that they did receive may and will affect you as part of your year-end tax planning. So do speak to the business, the rest of the business ownership group, the accounting firm of the business group, to make sure that you're at least know what your window is with PPP money, without PPP money, so that you're prepared for that potential tax liability come April of next year, or be able to position yourselves at 110% safe harbor right now and get caught up with some additional federal withholding and potentially Illinois and or your state withholding as well for this potential implication. Next slide, please. And with that, I'll turn it over to Natalie.
Right, I'm going to discuss some of the individual sides and some planning as we're looking towards the end of 2020, which has been a great year. So if we look at our ordinary, it's kind of good to know where you sit for your tax brackets, and it's good to notice where things change. So the biggest change, and something to kind of be aware of, is that change between the 24 and 32% bracket. That can cause some surprises potentially, you know, when you're filing your tax return. So it's a good idea to kind of do some planning if you've had surprises in the past where your withholding and your estimates haven't been adequate, to make sure that you've got enough paid in so that you're not in a penalty situation. There's things like the Medicare surtax, which is 0.9%, you know, once married individuals hit $250,000 of wages. There's different things that play in. So really, you know, kind of having a plan and working with your advisor to make sure that you're covered is really important, especially as we're getting towards the end of the year. Another thing I want to point out, which is really different, and it's been this way for the past few years with the Trump reform, but looking at the standard deduction. Prior to tax reform, you know, most of us itemized our deductions. If you owned a home, you had real estate taxes, you had a mortgage, were charitable, you know, things like that, you itemized your deductions. The standard deduction was pretty low, and that didn't really have an impact for most people. But now, if you look kind of at the single and married, which is the way most people file, $12,400 for single and $24,800 for married is automatically given to you as a deduction. If your deductions are more than that, then you're able to, you know, then they start to make sense. Then you would use the higher amount. So the biggest thing that came into play was taxes. So you can only deduct $10,000 of taxes, whether you're married or single. And that includes real estate taxes, which of course in Illinois are ridiculous, and your Illinois withholding or income tax that you pay in. So really you're capped at that $10,000, and then the difference you have to look at would be your mortgage interest, and then which is low, so typically, you know, that's super huge anymore. And the other thing that you'd need to look at is your charity. So in planning, you know, there's been a lot of talk of bunching your charity, and to kind of expand on that a little bit more, say you typically give $5,000 a year to your place of worship. You might want to consider, you know, depending on where your income lies in 2020, or maybe save it for 2021, you might want to bunch, say, 3 years in a row. So if you have the money, you know, give $15,000. So then you actually get a benefit of what you're giving to the church. You know, you're doing something good, and then you're also receiving a little tax reward as well. So those are things to just consider, knowing your brackets, knowing your standard deduction, and where you can maybe do some planning to give yourself a little bit of a benefit. Next slide, please. So the next thing I want to talk about, there's, you know, the rates we just looked at were for ordinary income. Ordinary income also includes short-term capital gains, but long-term capital gains, you know, capital assets that you've owned for more than a year, receive a special treatment. And those rates are shown here. There's a couple things that I want to point out, because, you know, everyone talks about the 15% bracket, but if your income, say you're in retirement phase and, you know, you've done some planning, in 2020 has been rough. If you happen to be below the amount in the 0% bracket, and that is your taxable income in total, then you'll pay no capital gains rates on either qualified dividends or capital gains. So that's kind of a unique place to be. Doesn't happen all that often, but for certain retired individuals, maybe children that are just starting to work, they might fall into those brackets, and that's something you can plan for. Most people will fall on the 15% bracket, and you can see those ranges listed below. But the thing that to be weary about is that 20% bracket. And if you have taxable income over the amounts listed, your gains, say if you sell a building, if you sell, some stock that's appreciated greatly, you could be surprised and be in that 20% bracket, which isn't talked about that much. So just kind of be aware there's some loss harvesting potentially that you can do to lower and bring yourself down back into that 15% bracket. Another thing I want to mention also is in addition to these 15 and 20% rates, there's also the Medicare surcharge, or net investment income tax, which it's more commonly called, which is 3.8%, which if basically you have an investment that you're not active in, it's another tax that's thrown above what we have now. Not to mention that Biden may completely throw these, Karen's going to talk about that. Things can completely change, but this is what's in existence for 2020. Next slide, please. And now we're going to kind of change pace and talk a little bit about IRA planning that can be done at the end of the year. There have been some changes. There was a Secure Act that came out at the end of 19, and those have caused some changes with IRAs. The first thing would be that a lot of individuals are now working past, the typical retirement age of, say, the 60s in the past, and are working into their 70s. Before they couldn't, if they were over 70 and a half, they couldn't contribute to their traditional IRAs if they had, even if they had earned income. But that has changed. So if individuals are working, that could potentially be a deduction for them on their tax return, or they can even contribute to a non-deductible contribution, but just continue to increase their retirement planning. The other thing would be the hot topic in talking with investment advisors and just other accountants would be considering Roth rollovers. Again, 2020 has been really unique. If it's been a year in which your income has dipped, or say, for example, you didn't take your required minimum distribution, as Karen mentioned, you could potentially do a Roth rollover from your traditional IRA. So this is something that we would want to look at prior to the end of the year. And to be nice to the investment advisors, you'd want to probably do it before December 31st because they need to make it happen. But it'd be a good idea to really look and see if making a Roth rollover contribution Roth rollover this year would be beneficial to you. Can you hit the next slide, please? It went back. Thank you. All right. So another thing to consider would be that the IRS has changed the required minimum distribution age. If you turned 70 and a half before 12/31/2019, nothing's changed. So you don't even have to listen. But if you turn 70 and a half after 12/31/2019, now you don't have to take your required minimum distribution until you turn 72. So that's something different. I've even heard talk of them wanting to raise it to 75. So we'll see what happens in the future, but that's a change that occurred for 2020. Karen already talked about the no double RMD, so we don't have to go through that again if you didn't take it in 2020. But something else that's still on the table, that's been on the table for a few years, is you can always do direct gifts to a charity up to $100,000 from your IRA. So if you're charitably inclined and you also would like to reduce the value of your IRA, you can do so through charitable gifts, knowing that there's not an RMD this year, but should these rules still exist next year, you can start doing that in early 2021 as well. Next slide, please.
Natalie, just one point, because
sure.
It's one of the questions that we get a lot too, is in terms of that Roth IRA conversion. I've had clients that have said, my account is $1 million. I don't want to do the $1 million. We don't have to do, we can do chunks of it. We can do pieces of it. And part of the tax planning opportunities is to look at what your effective tax rate might be if you converted 100,000 or 200,000 or 300,000. So that's one of the things people think, that it might be all or nothing. and it's just taking pieces of it out and converting it into that Roth IRA over time. Is that correct?
That's correct.
Yep.
Okay, now we can do next slide. And Deanna, it's back to you.
Great. So pass-through entities, partnerships, and S-corps. We've got a lot of alphabet soup here today. We're talking about PPP and RMDs, and now we're going to talk about QBI for just a few minutes. The qualified business income deduction is also another significant effect of the Trump administration in terms of redefining what used to be the domestic production activity credit. And it was what I call a haircut. So if I'm a business owner and my business income is $500,000 at the bottom line, my taxable business income, and I'm a 100% owner, traditionally speaking, I would have to pick up $500,000 on my individual tax return and pay the taxes accordingly. But with QBI, qualified business income deduction, should I qualify under the terms of a service organization, I will get what is a 20% reduction of that. So thereby, I'm only paying income taxes on $400,000. $500,000 at 20% haircut is a $400,000. This was the effects of lowering C Corp tax rates a few years back from the highest 39.6% down to a flat 21%. So we had some of our businesses who are pass-throughs going, why am I an S Corp? Why am I a pass-through entity? I need to go back and be a C Corporation. We were like, time out, time out. Let's think about the end game in mind. You may want to be a C Corporation now to get the 21% effective tax rate, but if I ever go to sell my business as a C Corporation, I have double taxation. Tax on the income of the gain and tax to get the distributions out. So pass-through entities are still one of our prime indicators of better tax planning for the longer term play. In any event, getting back to QBI, when business owners are looking at the year end and maybe wanting to give bonuses to their employees, maybe to lower their effective tax rates, they're going to give some money out that way, or perhaps take a distribution from their business as well. It's important to remember the QBI deduction, because if I'm an owner, I'm a 100% owner, and I want to take $100,000 out because I want to lower my business income, all I'm doing is putting it on my W-2. So I'm really not making any difference there. My wages go up and my business income goes down. So paying compensation if I'm a 100% owner, and further, I'm also reducing the opportunity for the QBI, because if my income, my K-1 income goes from $500,000 to $400,000 because I decided to pay a bonus out, just lost 20% on that $100,000. So the planning opportunities around business year end in terms of when do I pay this and how do I pay this out? We do have some number of clients that have had fabulous years. They're in the environmental space of hand sanitizers and chemical manufacturing and providing face shields and masks and things like that. So they're looking on how to significantly reduce their effective taxes in this year because they've had such a great year. For those that have had softer years, I don't want to say have poor years, but just have had softer years, there's still tax planning there too. In terms of the tax rates we know today, we know what they are for 2020. We don't know what the tax rates are going to be in 2021. It will and likely take Biden at least some time in order to get his legislative actions into place, clearly with the House being of a different party, but nevertheless, effective tax rates will likely go up. We have a new legislative body in the White House, and that is something we do know will happen. We don't know really when, though. Is it a 2021 play? Is it a 2022 play? But understanding what we know today in 2020, whether we've had a great business year or a softer business year, being able to talk around those tax rates and those opportunities. 12 years ago, we were talking about accelerating income and decelerating or slowing down my expenses. It may be that for you too, because we may want to accelerate our income here in 2020. Doesn't sound like that's logical, but knowing that effective tax rates will increase next year or in the year after, I may want to have more income tax this year because we know what the effective tax rate is, and it may be in fact at a lower effective tax rate overall. Year-end accruals and payment requirements, just as a reminder for business owners, accruals, if you're on an accrual basis of accounting, you can accrue deductions and have them be effectively deducted for tax purposes. and pay them after the end of the year. There's certain requirements in terms of that. So just, again, talk to your accountants and advisors to make sure as you're rolling up your sleeves on your business tax planning that you're looking at all the different buckets: tax credits, QBI, compensation, distributions, effective tax rates, pre and post PPP money. These are all part of what we're talking to our clients about right now, because it's going to matter. Nobody wants surprises come April. We've got enough surprises going on in our lives. We don't need any more surprises. And so if we can actually gauge and create boundaries for which our cash flow will be needed for tax planning, and doing that now, at least we'll have a better idea of what we need, you know, come next spring. Next slide, please. And now to Karen.
And Deanna alluded to this. What do we know today? Natalie walked through the tax brackets. That's our playbook for 2020. What we don't know is what is our playbook for 2021, or what is our playbook for 2022. And I just want to talk through the 4 main provisions of the Biden tax proposal. Right now, C corporations, and when you think of C corporations, think of publicly traded companies. Think of those corporations that are not of a mid-sized nature that might be flow through. Right now, they are enjoying a 21% tax rate, which is a historically low tax rate. Previously, or I guess currently, it's 21%, but under Biden, he's considering jumping up to 28%. So effectively raising the C corporation tax rates by 1/3. So again, when you think of publicly traded companies, the hit on the bottom line as far as tax cost will be pretty significant. Income and payroll taxes. So now we're talking about individuals. So right now, as an individual, you pay a highest tax rate of 37%. You also pay Social Security tax of 6.2% on your earnings up to something like $130,000. What Biden is proposing is taking that 37% tax rate and ratcheting it up to 39.6%, which is what the tax rate has been historically with a Democratic president. Additionally, if you have earnings of over $400,000, that 6.2% that I just talked about, it does cap at that $130,000 or so, but then it restarts above $400,000. So again, if you are making more than $400,000 between the FICA tax and the income tax rate, we're jumping from 37% to 45.8%. We talked briefly about the qualified business income deduction, the QBI. In effect, Biden is considering getting rid of that. So again, the QBI was a function of an offset to the lower C corporation rates. So what he's suggesting is, I'm going to raise the rates back on C corporations to where they were, and by doing so, I'm also going to eliminate the qualified business income deduction. So for small business owners, we could be looking at a 10% increase in taxes. And finally, this is, other than one of the items that Natalie's going to talk about, I think this is the most impactful. And I'm hearing from clients that don't really understand this jump in the capital gains and dividends tax. I had a client email me yesterday and say, well, I heard my capital gains tax rate is going to double, so I'm going to sell everything today. And that got a pretty quick phone call back to say, please don't. In effect, if you are a high income taxpayer, right now you're going to pay 23.8% on your long-term capital gains rate, as well as on qualified dividends. We showed you the brackets earlier. It could be less than that, but that's the maximum tax rate. Under Biden, if you are making more than $1 million, so effectively we're talking about some pretty high net worth individuals, that 23.8% very well could be 43.4%. So it's, again, as we're talking about year-end tax planning, when we don't know if this is going to be a 2021 or a 2022, we're reading the tea leaves. That the old adage of let's defer income, accelerate deductions, in an environment where we're seeing increased tax rates on the horizon, it just doesn't hold as much water. So this year's tax planning hasn't been, let's just look at 2020 in a bubble. It's more, let's look at what it is in the future. And as far as the effective date, not to get too political, but Deanna mentioned right now we have a House divided. But January 5th, there's going to be a runoff in Georgia, and effectively that could really swing how much power the Democrats have. If the Democrats win that runoff, it's possible that these could be 2021 tax rates. Again, none of us have a crystal ball, but the tea leaves are they're going to be higher tax rates. Next slide, please. And with that, I want to turn it over to Natalie, and her top point is going to be this first one. So really pay attention to this.
So I'm going to talk about the changes potentially under Biden for estate tax. The first thing that I want to talk about, which may happen, there have been 3 attempts in the past for this to occur, and none of them have been successful. There's this thing called a step-up in basis, which occurs when somebody passes away. So their assets that they hold, which are non-retirement, so anything, stocks, things like that, receive a step-up in basis when they die. So say they held a stack, they bought it for $1,000, 50 years ago, and now it's worth $100,000. There's a $99,000 built-in gain on that stock. The way that the current regime works, whether or not you file an estate tax return, this happens for everybody, rich, poor, wherever you stand, that $1,000 stock that they purchased is now in the hands of the heir, $100,000 of basis. So if they turn around and sell it the day after, grandma passes away, they have no gain, say if nothing drastic happened in a day in the stock market. But, it's a wonderful thing, and it really does impact all, sorts of people. But this is possibly on the chopping block. It's been something he's talked about where, okay, grandma dies, now you have a stock that your basis is $1,000. You're going to pay tax on $99,000 of income. And as Karen mentioned, those rates in potentially 2021 could really skyrocket. So this is something that, is on the table. We can't really plan for this at this point, but once it is decided, you might want to do some, sales of some really low basis assets and, lost harvest to offset it. But there's a lot of things that can kind of be done once we know. But this is one where really at this point, there's not much we can do. The other big thing that Biden is considering is reducing the exemption for lifetime gifts. Currently, we're at the highest, exemption rate exemption amount that we've ever been at historically. Each individual can die with $11.58 million of assets and not pay any tax, estate tax, that is. So this is great, for a married couple, it's $23 million of income or of assets, and you don't pay, any transfer taxes on this. What the proposal, well, first let me talk, in 2026, this is slated to go back down to the pre-Trump amounts, and that is 5.8 million. There'll be indexes for inflation. So that's 5.8 million per person. So you're losing essentially $5 million of wealth transfer per person. So this is something that's, if Biden is elected, he's been talking about reverting back to that 2026, reverting back to that 5.8, moving it up from 2026 to potentially 2021. So with that, there's some planning that we can do, and it's really going to center around those individuals who are between the 5.8 and the 11.58 amount. Can you click the next slide, please? So in dealing with some planning, there are quite a bit of things that you can do, and we don't want to kill the estate planning advisors or attorneys. So really, if you're kind of in that situation, you might want to talk to them really soon because they're going to have a really rough year end with all of these potential changes. But there are a number of strategies that you can do to kind of start using that exemption that may disappear. Some things that you can consider would be if there's any loans outstanding to families or any like estate planning loans that have existed, you might want to do some debt forgiveness by the end of the year. Some other things, there's all kinds of planning techniques which are really complicated, usually involve an attorney, accountant, everyone under the sun, and they're usually, letters. So we got GRATs, SLATs, tons of different planning techniques where we can kind of utilize that exemption amount right now. So those are things that, you'd want to talk to with your attorney. And then another thing to consider would be, if you own a business and if it's multi-generational, you're really looking, grandson or son is really active in the business and you want to get some ownership down to them, it might be a good idea to look to do that before 2020, given that we really don't know when any of these changes may occur. One other thing I want to talk about, and that's really kind of nice and a relief, is that the IRS has stated that they will not claw back any of these transfers that have occurred, even if the amount of exemption decreases. So they've put this in writing. This is their intention, is that, any transfers that you make between that 5.8 and 11.58 million kind of amount, even if it reverts back, that you won't be penalized for doing so. So that is definitely a relief. And with that, I believe we're finished, so we can go back to Lily.
Awesome, ladies, thank you so much. And we do not have many questions due to the audio issues. Thank you all for your patience. We've been navigating a solution with GoToWebinar, but I will be sending all the registrants the recording of the webinar. And you can just respond to that email of the recording with any questions you have for our panelists. I'll make sure to direct them and forward them appropriately. But is there anything else, Deanna, that you and the other panelists would like to cover before passing off to Nicole?
I get one final thought as Natalie was kind of wrapping up on the estate planning opportunities. Our firm also performs a number of business valuation services. So as businesses potentially considers to do any gifting, they will likely need the services of a business valuation in order to determine the stock value of the gifts that are being made to whomever it is in the organization. The other thing, in terms of dusting off your estate planning documents as business owners, have really good agreements. Your buy-sell agreements need to be intact in the terms of all the what ifs. If I die today, what does my family get? And these documents are really more about the people that aren't in the room, the people that are your beneficiaries, your family members. So whether you're an individual that has an estate plan that hasn't been updated for a long time, definitely reach out to your attorneys to do so. If you're a business owner and you have a good estate plan in place, but you haven't necessarily got your documents in order with respect to your buy-sell agreements with your fellow shareholders and partners, it's another great opportunity to make sure that you're planning for value and the transferability of value as we're coming into this potential change in estate planning.
Thanks so much. We actually did just have a question pop up. What are your thoughts about the Illinois income tax rates going forward?
Yeah, I can take that one. Effectively, it's similar to knowing what Biden's tax plan is we all voted in November on the Illinois fair tax. It did not pass, but the concept is, I wouldn't say this is, forgotten. Illinois is going to have to raise their tax rates. They weren't able to do it with this go around, but effectively, in order to change the tax rate, it's going to require a change in the Illinois Constitution. So it's essentially a higher level of taxpayer confirmation of being able to raise the tax rates. So I don't think it's gone. In fact, I think people understand the environment that we're in today, and with all the debt issues that we have in the state, we still have a lot of clients that are talking to us about, do I stay an Illinois resident? Particularly now that we're talking, in a land of COVID, people are not necessarily tethered to their desks in downtown Chicago. They can really work from anywhere. So, between the work from anywhere concept as well as rising tax rates in the state of Illinois, we are doing a lot of advising of clients on how do we change our domicile so that perhaps we become a resident of Texas, which doesn't have an income tax, or a resident of Florida that doesn't have an income tax or an estate tax. So again, our opinion is the tax rates are going to increase. It's just a matter of when.
Great, thank you so much. And I will pass the mic to Nicole now.
Thanks, Lily. Thank you, Deanna, Karen, and Natalie, for sharing your wisdom with us today. We appreciate you setting us up with a strong foundation for what will be an evolving and ongoing topic of conversation. A key takeaway is you will benefit immensely from having your entire team of professionals coordinate to ensure that you've addressed any opportunities and/or potential vulnerabilities in your overall financial plan. Thank you everyone for attending this webinar. As Lily has shared, we will send out a recording. If you have further questions or perhaps have a specific question about your individual situation, please feel free to contact any one of the panelists or your private Vista advisor. From our family to your family, we wish you a happy and healthy holiday season. Thanks and enjoy the rest of your day.